Hello and welcome to the Flipping and Wholesaling Houses in New York show. I am Michael Pinter. I teach you how to start flipping or wholesaling houses in New York, or if you're already doing it, how to grow your business. Now, I'm getting great questions. This one is, what is equity in real estate? It sounds like a general question, but it's a great question. And I'm going to define it in the beginning, and then at the end, if you stay to the end, I'm going to explain really how it works. If you want to borrow money for buying deals and what the equity part of the deal is and what you can do about it. Okay. So in general, what equity means, right, in real estate is the portion of a property that you don't owe. It's the part of the property that you own, right? So a standard person buys a house, they might borrow 90% and they're going to put 10% down, and that 10% is their equity in the property. It's the part that they don't owe on, right? Now theoretically, if I bought a property for $100,000 and I borrowed 90 sorry, let me get a water. I borrowed $90,000, but then it was worth, price appreciation took it to $150,000. So now my equity is $60,000 in theory, right? That's the part of the value of the property that I don't owe any money on. That's a simple answer. And obviously equity can mean other things. I was a stockbroker a long time ago. Equity means stocks, right? Because when you buy a stock certificate, you actually own a piece of the company, right? As opposed to debt if you buy a bond, right? So equity and debt are like the two components of owning something, right? So even on a publicly traded thing, and I don't know why the hell I'm talking about this, you can either, a company can raise money with debt or equity. Equity means they issue stock, and debt means that they issue bonds and people buy bonds. So that's debt that they owe money back on. Equity means somebody else owns a piece of them. And it's the same on a piece of real estate, right? There's debt and there's equity. If I have a property and it's worth $200,000 and I have a $200,000 loan on it, I have $200,000 in debt. I have no equity in it. So it's described a lot in real estate as, how much equity do you have in the house, right? So that can mean whatever. Now let's understand something. It's almost always a guess, right? Because you think you know exactly what your house is worth, but may not be worth what you think it's worth, right? You may think your house is worth $200,000, but when you go to sell, you're only getting $180,000 for it. You might have less equity than you thought. Now, when you are borrowing money on an investment property or a flip deal or any kind of deal, the lender wants to know how much equity you're going to have, which really means how much of a down payment are you going to put into it. Or, right, if you're refinancing, how much equity are you going to have? They're always going to give you a certain percentage, right? A loan to value, an LTV. And what that basically means is that the lender is willing to take a certain amount of risk, right? So the lender on a refinance might say, we're going to only take 70% of the value. And the value when you're borrowing money is always going to be based on an appraisal, usually based on an appraisal. And the lender's going to say, okay, the property appraised for $200,000. We're going to lend you 75%. We're going to give you $150,000, and you'll have $50,000 in equity. The general idea on any lender in any real estate transaction is that they don't want to be the one holding the bag for all the risk. Now, sometimes on a hard money deal, sometimes the lender will take a lot of risk because based on the appraisal, the subject to appraisal. So the way it works on hard money deals usually is that you're going to do an appraisal, but you're going to tell the appraiser what work you're going to do. So, Mr. Appraiser, this is this crap hole of a house I'm buying, or whatever house. It doesn't have to be a crap hole, sorry. And I'm going to put in a new kitchen. I'm going to put in new bathrooms. I'm going to put in a new roof, and this is what I'm going to spend on it. And the appraiser will do a subject to appraisal, which is that house is going to be worth $400,000 when you're done doing the work, even though you're buying it for $200,000 now. And the lenders are going to say, we'll lend you up to usually 65 to 70% of whatever that value is going to be, the ARV, the after repaired value. But they always want to see you put some money into the game. Now, there are lenders out there that will lend you 100%. It's very rare. Most want to see at least 10% of the purchase price plus the closing costs go into the deal from the borrower. Usually. Some of them want more. If it's your first deal, if you have credit issues, some lenders are going to give you only 80%. They want you to put 20% down. But in any situation where you're borrowing or you're buying, the equity portion is the portion that you're not borrowing. So when I started this business, right, in 2013, I was basically a complete idiot. And what I did, looking back, it worked, right? And I tell people they'll do this only if you have to. What I did is I got hard money on every loan, on every deal. And then I borrowed from an equity investor. So You might think this is like private money lender, and I guess it was. And they would fill in the gap, right? So if that was 10 or 20% on the purchase, plus they would fund closing costs. And then I would borrow the hard money. They would give me the money for the construction too. The problem with that, right? And I'm not saying don't do this. I'm just saying that the issue with that is at the end, when a deal was sold, on every deal, there was a huge interest payment to the lender. And then I had to split the profits with the equity investor. Now, it's not terrible. And it got me going, and it got more deals done every year. But what I realized after a while is that there's almost three partners in these deals, right? There's a lender, there's the equity investor, and there's me. So ideally, you can have a private money lender who's going to fund the whole thing, or an equity investor is going to just take a standard percentage on his return instead of I'm just throwing out numbers. It's not always the same, but you'll pay a hard money lender, let's say 10%, and maybe you'll pay the equity investor 11% or 12%, and you're just going to pay him that. That's not so bad, because then you can calculate on the whole deal, I'm going to have 11% based on how much time it takes. But if you're giving we were giving huge chunks of profit to these investors, and it was hard to stomach. Now, again, if that's what you need to get business started, do it. But you need to really look into how you structure those things. And there are equity brokers out there right now, a lot, tons, right? So what does that mean? That means that there are mortgage brokers out there for commercial deals, residential deals, who are going to lend you a percentage of it. And then there's equity brokers who say, we'll find someone who'll put up the rest of the money. And there are standard, I'm not going to say standard, it's always negotiated what the equity investor is going to get. You know, pay the equity broker a percentage on just for finding the prop for the person who's going to give you money. And then that person is usually going to get a preferred rate of return. So let's say 6%. I'm just saying, throwing numbers out of my tokens. They changes all the time. A 6% preferred rate of return, which means they get paid before you do. What is it with this? Every time I move, this thing is getting blurry. And then they'll get a percentage of the profits too. It's different. It depends on the size of the deal. It depends how good the deal is. It depends on a lot of things, right? How much what the terms you're getting from on the debt. But that's how equity works. And I guarantee you there are equity brokers everywhere. They're all and I say this to people all the time. So people come to me all the time and say, I can't start flipping yet because I don't have a lender. And I say to them the same thing every time. I go, you're just wasting your time. Go out and find good deals. Start marketing. The only things you should be doing when you are starting out in this business, there are only two things, nothing else. One is learning, and congratulations, you found the one son of a bitch in the world who teaches how this works in New York, because New York is dramatically different from the other 49 states. Sorry, kick the tripod. So learning. And the other thing is marketing for deals, marketing for sellers. That's it, right? Anything else you're spending time on, anything else, finding a lender, designing a logo, ordering business cards, building a buyer's list, all those things are complete bullshit, because when you find a good deal, money finds you, right? And buyers will find you, and everybody will find you. And good deals are easy to fund, and they're easy to sell. Good deals are amazing. So the only thing you should be spending time on, again, is learning and marketing for deals with sellers. That's it. So I hope this was helpful talking about equity. I mean, I know I got off on a couple of tangents, but equity is a very broad topic. So a couple things now. If you're interested in the ways I can help you, go to, sorry, Jesus, this is vibrating. Maybe that was why it was blurry before. If you're interested in the various ways I can help you, go to howtoflipnewyork.com. If you're interested in my course that teaches how to do this, go to howtoflipnewyorkcourse.com. If you are interested in coaching from me, go to coaching.howtoflipnewyork.com. If you're watching on YouTube, please subscribe. If you are watching on any platform, I don't know where you're watching this, you please click like. A thumbs up really helps me. And please keep the comments coming. There are no bad comments. So I'm answering every comment. I'm down to, I think, 2 more that I have to answer. I try to get to them as soon as I can. I look at them every day. Sometimes I look at one and my head wants to explode because it's either too general or it doesn't matter. I'll still answer. And I had like a 4 that I was sort of pushing off, like subconsciously. I just didn't want to answer them. And I responded today. I need more clarification. I'll be happy to answer. So keep the comments coming because they help me, right? I go live 5 times a week. Sometimes I don't know what the hell I'm going to say. So the comments help me by giving me topics to talk about. So I really appreciate the comments. Again, if it's a simple comment, I'll just reply with an answer. If it's something that I've handled in depth, or I just did a video on it, I'll just send you a link to the video. I did that today. Someone asked me about something and I completely answered that in a video, so I'll just send you a link. And if it's something that I haven't handled in a while, I haven't covered in a while, or it's something maybe I've never covered, then I will do a video on it. But you will get all your questions answered via comments. My phone number is on the page. Also, you can call me. I'm happy to help you in any way I can. And I really, from the bottom of my heart, thank you for watching. I really appreciate it. Everybody that watches is somebody that I owe gratitude to, even though, especially because you have to listen to that horrible buzzing sound. So thank you very much for watching, and I'll see you tomorrow.